Good morning, everyone. My name is Amari Pito, and I will be your host with you this morning. First of all, thank you for joining us for this third webinar of the Funds Week series. I see that we have 3 countries on the line, which is pleasing to see. And I hope that you will find this presentation insightful. Today we have Ryan Clotter with us this morning. Ryan joined the Catalyst Fund Managers in 2019 as an investment analyst. He's a qualified chartered accountant, and after completing his article in the Banking and Capital Market Division of PwC Joburg and a secondment of the Asset Management Division of PwC Los Angeles, he joined Fairtree Capital in 2014, and he was a co-portfolio manager of the global listed real estate fund. Well, some housekeeping before we start. If you have any question, please use the chat box at the bottom of your screen, and we will endeavor to answer all your questions. Towards the end of the presentation, I will also enable your microphones should you have any question for Ryan and his team, as to make the presentation a little bit more interactful, if I can say it this way. Well, but without further ado, I'll hand over to Ryan now. But thank you again, Ryan, for your time this morning.
Thanks, Amara, and thanks for affording us the opportunity. Thank you, everybody who's joined. We appreciate you giving us the time. I'm going to share my screen now, and we can sort of start going through the presentation pack. Amara, is it sharing on full screen? Can you see?
Yes, we can see them.
Okay, great. Thank you. So yeah, thanks everybody. I mean, today is obviously, your guys' presentation. So please ask as many questions as you like. There will obviously be Q&A at the end. I mean, I think for purposes of today, just maybe sort of 2 main things we'd like to highlight. I think the first part is just, talking to global listed real estate as an asset class, getting to sort of maybe appreciate the asset class a little bit better. And then the second part, we'll talk a little bit more about ourselves, about our particular fund, about Catalyst Fund Managers, and look at our fund sort of performance and composition. So just sort of with the introductory part, with the asset class overview, I think a good starting point is just to look and see, how has global listed real estate performed versus other asset classes. And I think the first thing we obviously noticed is, in the last year, global listed real estate actually underperformed global equities and global bonds quite significantly. And I think the obvious question from that, is this a great, entry point potentially into listed real estate, or is there a fundamental issue in the asset class? And we'll try and address that. Obviously our view is more so that, real estate has lagged equities and potentially is a good entry point. I think sort of looking on a longer term period, you can see sort of over a 10-year basis, real estate has performed somewhere in between equities and bonds, and that's typically the type of return we'd be expecting over a longer term horizon. I think interesting just to note, over a 25-year basis, global listed real estate has actually outperformed both global equities and bonds. Maybe just to touch on this slide very quickly, interesting to note that global listed real estate actually has a higher correlation to global equities, as shown by the gray bars, more so than it does to global bonds. And I pointed out for 2 reasons. Certain markets, I'll take the South African listed property market, for example, is actually higher correlated to bonds. That's not the case here. And the second reason I pointed out is, we're in an environment where rates are rising. And one of the questions we get a lot is, can real estate do well in a rising rate environment? And this is just to show that, over the long term, listed real estate is not actually as correlated to global bonds as people might think. This chart shows the sectoral return of global listed real estate last year. So, global listed real estate as a whole last year, it was quite a tough year because of COVID. The sector was down 8% in dollars. However, you need to drill down a little bit deeper into that and look at, what the underlying sectors did. And if you look at the dark lines in this chart, you can see there was an enormous divergence between the winners and losers between the different sectors within listed real estate. Something like malls and hotels were down close to 30%, whereas something like industrial and data centers were up sort of mid to high teens, pushing 20%. Okay, and I think throughout the course of today, I'll sort of keep coming back to this, but I think the key message that I'd really like to leave with everyone today is just the depth and breadth of opportunity set within the global listed real estate universe is actually enormous, and I think it's something that's often underappreciated by the market. The market often thinks of real estate as a bond proxy and everything moves in tandem with bonds. And I think this chart illustrates quite well that that is not the case. Each of these sectors have different economic drivers. Some of them, will do well in a high growth environment. Others will do well in a low growth environment. The point I just want to emphasize here is that really global listed real estate in particular is a very diversified and broad opportunity set. I think the other thing that I'll just point out on this slide is, if you look at the dark lines, like I said, that's sort of, performance returns for the sectors on the full year. What we saw in the fourth quarter of last year, obviously we had the vaccine news and we had this risk on vaccine rally. You can see a lot of these sectors that were actually quite beaten up had an incredibly strong fourth quarter, shown by the lighter lines over here. Malls recovered almost 40%, hotels were up over 40%, and that's in the fourth quarter alone. Okay. Interesting to note that these full year returns shown by the dark lines actually already includes this recovery. So it just shows, how badly some of these sectors sold off, but then also how strong the recovery was. I think maybe just going to the next slide again. So just trying to sort of, set the scene on global listed real estate. I think the perspective is for many investors, and particularly generalists, often think of global listed real estate as something that comprises probably offices, retail, and maybe a bit of industrial. This slide over here just shows how the sector has evolved over the last 20 odd years. We view real estate as a proxy for the way we live our lives. It facilitates the way we work, sleep, eat, and play. And just as our lives have developed over the last sort of 2 decades, so has the underlying real estate which facilitates this. If we go back to the late 90s, you can see about 77% of our sector comprised of the traditional sectors, office, retail, apartments, industrials, and hotels. Sort of forward wind to today, and those traditional sectors make up only 36% of our benchmark. We've had a lot of new sectors coming in, something like data centers, which we'll talk a little bit about, that facilitates, data storage and transmission. As the world has become more and more digital and online, the data center sector has evolved. We now have other new sectors like niche residential housing. We have gaming leases, all forms of new sectors that have come into the space as the underlying economy has evolved. So the purpose of this slide is just to kind of drive home that real estate is not an old tired sector. There's actually a lot of very interesting subsectors that have evolved as the global economy has evolved. Maybe just sort of one more high-level slide before we get into it. A question we often get from investors, particularly this last year as we've gone through the COVID crisis, is how does the listed real estate sector compare now to the previous crisis, being the GFC? And I think this slide shows quite well that the sector has evolved and actually improved quite a bit. Okay. Starting off with the chart on the right-hand side, this shows the company's loan to value. So this is level of indebtedness. This is basically your debt to asset value. And you can see going into the GFC, listed real estate had on average 44-45% loan to value. Okay. Going into the COVID pandemic beginning of last year, the sector's gearing has come down significantly. The sector's sitting on 29-30% loan to value. So firstly, your level of debt has reduced significantly. Secondly, prior to the GFC, a lot of these large global REITs, their finance came from very limited source. It would not be uncommon for them to have 1 or 2 banking relationships. All their loans were coming due in the next 12 to 18 months. What obviously then happened in the GFC, these companies were forced to, they couldn't refinance some of these loans and they had to do heavily discounted rights issues, which obviously wasn't great. forward wind to today, and what we see is that, you know, the companies, and we're talking generally, there are obviously exceptions, but by and large, the companies have laddered their debt maturities much, much better than they were prior to the GFC. You know, a lot of the companies we cover, we've actually seen them recently issue 30-year debt. Okay, so that's just staggering their maturity profiles. They're never stuck in the position where they suddenly need to refinance in a crisis. So we've had levels of debt come down. We've had maturity profiles improve. Diversification of debt sources has improved. So the balance sheets of these companies are in a much better position compared to where they were going into the GFC. On the left-hand side, I just show, you know, if you kind of take a step back and you look at real estate very high level, it comes down to supply and demand. Okay. Now, if you look at this chart on the left-hand side and you look at the light blue line and look at it towards the right-hand side axis, this shows new supply of space coming online as a percentage of existing space. Okay. And you can see, you know, on average, you know, all the way back to the 80s, you've had on average about, you know, 1.7% of new space come online every year. What we noticed is that since the GFC, obviously, you know, developers went bankrupt, people stopped developing, and supply sort of fell off a cliff. But since the GFC, supplies, you know, ticked up, but it has not exceeded its long-term average. In fact, going into the COVID pandemic, supply was actually below its long-term average, you know, sitting at about 1.5% of new space coming online. To put that in perspective, you know, buildings have a certain limited lifespan of about 100 years. So you have about 1% of space going offline every year just because it's redundant, you know. So if you have 1% coming off, you supply 1.5%, that's actually, you know, quite manageable, and the market can absorb that. You know, again, look at prior cycles. You can see going into the GFC, prior to that, there was a bit of oversupply in the market. So long story short, what this slide is trying to show is that, you know, global listed real estate is in a much better position compared to where it was going into the GFC. So that's sort of to set the scene. I think maybe to move on, you know, to the second part of the presentation, which is more, you know, about Catalyst, about our fund, and about our portfolio. As a starting point, I mean, maybe just to give you sort of a few pointers of things that we think makes us unique. I think the first thing is we operate in a single asset class. You know, we look at listed real estate both in South Africa and across the globe, and that's all we do. We've been doing that for 20 years now, and that is our area of expertise. And we believe something like real estate, you know, as we'll delve into in a few minutes, is very unique and actually requires that specialist knowledge. Another thing I'd point out is that, you know, we believe our company is very good alignment. 85% of our staff are shareholders in the business. You know, that helps retain talent. It helps align the interests of individuals with the company and with investors, and we think that's great. But I think if I take a step back and you said to me, you know, what do you believe is the single biggest differentiator of Catalyst, and what makes us unique? What's our secret sauce? I would say it's the 3 Ps. It's very cliched, and forgive me for it, but, you know, our people have led to our process, which has led to our performance. So it all basically starts with our people. If you look at our investment team, we have an investment team of 12 individuals who look at real estate and only listed real estate. You can see sort of from the average age or the average years of experience, we have an incredibly experienced team. But I think more importantly than that is the fact that many of our senior members actually came from from physical real estate backgrounds. You know, someone like Andre, who was our founder, you know, headed up Old Mutual's retail property portfolio. So he was involved in, you know, developing malls from the planning stage to the permissioning stage to the actual development stage to the letting and reletting, all of that, as were many others of our senior team members. And that's important because, you know, having had that physical real estate exposure and background, and having really had to learn how real estate operates on a day-to-day basis, you know, something, for example, like capital expenditure. How much money do you have to spend on a property to keep it in its existing condition? You know, we feel that that's something that the market often underappreciates, okay? So having a team that has had that physical property experience, that really understands understands real estate really well, has led to our process. Okay. Now, I could go on hours speaking about our process. I won't bore you with that. But basically, we have a very rigorous investment process. You know, we in the global universe, we have about 140 stocks, which we call our core universe. And for all those 140 stocks, we do detailed bottom-up 5-year DCF models. Okay, so we model each of those stocks in incredible detail. Again, we believe our experience in the physical real estate market has improved the way we think of those companies, in modeling their cash flows. And like I said earlier, CapEx, I think, is a perfect example. We think the market often underappreciates that. We've seen, particularly in tough economic years, companies often underspend on their assets. They cut back on CapEx, and you don't notice it immediately. The problem is if you don't spend money on the assets, those assets are going to deteriorate over time. And they're either going to, deteriorate in quality, or you're going to have to spend that money later on. So we spend a large amount of time thinking about the CapEx that needs to be spent, and we model that CapEx, even if the company's not spending it. The other part of our investment approach is, we build up a required rate of return for each and every stock in our investment universe. Again, I won't bore you with too many details, but, simplistically, if I said to you, would you, if you were to invest in a US banking stock, for example, what would the required rate of return be that you had for that? Versus if you were going to invest in an exploratory mine in Africa, what would the required rate of return be that you would have for that? What would you want as an investor? Obviously, you would want more for the risk of investing into an exploratory mine. Likewise, when we look at our real estate stocks, we have scorecards where we build up, we look at various risk metrics, and for stocks which have higher risk, we require a greater return. Okay. All of that, like I say, our people have led to our process, which is a very robust bottom-up fundamentals investment process, and that has ultimately led to our performance. This chart shows our performance over various time periods. You can see in the top line, the fund's performance in US dollars over various time frames, followed by the benchmark, and obviously the differential being the alpha that we've managed to generate. Again, what's that come from? It's come from our people who really understand real estate, which has led to what we believe is a superior and robust investment process and methodology, and that has translated into what we believe is good performance. Maybe just moving on to our fund, and sort of the composition of it. I think this slide is probably one of the most interesting slides. The chart on the left-hand side shows the geographic diversification of our fund, how it's split up. But I think more importantly is the chart on the right-hand side, because that shows the sectoral breakdown and allocation of our fund. And again, I mentioned it earlier, and I said I'd come back to it. We think that this is probably the most underappreciated thing regarding global listed real estate, and that's just the depth and the breadth of the opportunity set that's out there. You can see from our fund composition, the various subsectors that we're exposed to. Now, that's great because obviously it gives us more opportunity having different subsectors, but more importantly, each of these sectors have different economic drivers. Some are facing structural headwinds, others structural tailwinds. Some are cyclical highs, others are cyclical lows. And what that allows us to construct different portfolios under different economic environments that we believe can do well. So if we're in a high growth risk on environment, we can construct a certain portfolio. If we're in a low growth risk off environment, we can construct a certain portfolio. So if I leave you with one thing today, it's just to appreciate the depth and the breadth of the opportunity set in global listed real estate. Maybe just to touch on a few of these sectors which are unique. You may or may not have come across them, and just to explain why we're excited about them. And don't worry, I won't go through them all, but maybe just to start off with something called single-family housing. So single-family housing is a sector that's quite unique to the US. It was born out of the global financial crisis. Basically what happened, or as the name alludes to, this comprises single-family standalone homes in the suburbs, so not apartments, but standalone homes. And what happened in the GFC and post the GFC is the banks repossessed millions of homes across the United States. And they sat with these homes on their balance sheets, and they ultimately sold them off to private equity funds and hedge funds for pennies on the dollar. These funds started aggregating these portfolios and ultimately spun some of them out into the public market, into the REITs that we can invest in today. Now, why are we excited about something like single-family housing is if you sort of take a step back and you look at residential real estate, your single biggest demand driver for residential real estate is demographics. Okay. Now, when we look at the US population and we break the US population down, the single largest living generation in the US at the moment are millennials. They recently overtaken the baby boomers. If you drill into that a little bit further, you can see that these millennials are now around about or approaching the age of 30. And that's significant because that's traditionally the age at which individuals would, move out of an apartment and move into a single family home. What we saw, with prior generations is that, many of those individuals would go and get a mortgage and buy their own home. What we see with the millennials is that they're not buying those homes. They're actually rather renting those homes. And there are a few reasons for that. Firstly, banks have tightened up on their lending criteria since the GFC. It's a lot tougher to get a mortgage. The millennials have come into the working world with an enormous amount of student debt around their necks, so they're already over indebted. And then lastly, and not to be underappreciated, is actually just behavioral preference. The millennial generation have shown that they, like freedom and flexibility. The idea of having a 20 or 30-year mortgage around their necks and being tied down is actually quite unattractive. They'd rather just rent where they can, move around quite quickly. So what this all leads to is that you've got this enormous demographic tailwind driving demand for these single-family homes. And instead of them going and buying their homes, they're actually renting them. And that's incredibly positive, for the companies, like Invitation Homes that we're invested in that own these large portfolios of single-family rentals. I think the chart on the right-hand side, maybe just to sort of, show the point of what happened over the last year. Last year with COVID, we saw a lot of real estate sectors coming under pressure. Tenants were asking for rent discounts, for rebates, for deferments, and all these things. If you look at this chart, you look at the green line, this shows, asking rent growth, so new leases, okay, and how much they've grown year on year. And you can see single family rentals actually incredibly strong pricing power. They were able to increase their rents, sort of mid to upper single digits last year, while most other sectors were going backwards. And that's incredibly positive, and it just shows the pricing power that these companies have because of this incredibly strong demographic tailwind. Just out of interest, if you look at the gray dotted line, that just shows apartment rents, and you can see how they fell during the pandemic last year. Maybe another sector to talk about, and one that we're positive on and like a lot, is a sector called data centers. So very simplistically, a data center is effectively a warehouse that stores data, storage, and processing equipment. Now, as we all know, we live in a world of ever-increasing data usage, data consumption. It's been happening for a couple of years and is likely to continue to happen for many years to come. The chart on the left-hand side just shows, anecdotally, just out of interest, for every minute of the day last year, 147,000 Facebook photos were uploaded. 208,000 participants sat in on Zoom meetings. The numbers are phenomenal. So we've got this incredibly strong demand for data center space as people consume and use more data. If you look at the chart on the right-hand side and still see, well, how did that translate? This shows new leasing activity in the top 6 data center markets in the US. Okay, so think of this as an indicator of demand. And you can see over the last couple of years, your quarterly new demand or new leasing has been about 89 megawatts per quarter. Okay, look what happened last year. Throughout the year, every quarter was significantly above that. Okay, why is that? Well, we've had this trend of ever-increasing data usage and consumption, which has led to strong demand for data center space. COVID came along and happened and actually accelerated that. You think of what we're doing today, the amount of virtual meetings that we've sat on since the start of the pandemic. Companies are seeing that, this is sort of the way of the future. And there's almost been a step change in the amount of data that we consume and process, and therefore needs to be stored. And that's enormously positive for a sector like data centers. Maybe just to sort of give one more example, something that I think we can all relate to is e-commerce and online retail. Now, this chart over here shows UK internet sales as a percentage of total retail sales for the last couple of years. What you can see is that there's been an ever-increasing trend of internet sales making up a bigger proportion of total retail sales in the UK. Now, what does it mean for real estate? Well, it's bad for the owners of shopping malls and shopping centers, because as retailers are focusing more and more of their energies and efforts on online channels, because that's where they're getting growth from, many of them are realizing that they need fewer physical stores, so they're reducing their physical stores. That's bad for the landlords. Or some of them are actually just going under and going bankrupt. We've seen a lot of bankruptcies in the US over the last couple of years. So this trend, which has been happening for a couple of years, is actually bad for the owners of shopping malls and shopping centers. If we look at the beginning of last year, just before the pandemic hit, you can see online sales were just under 20% of total retail sales in the UK. By the end of last year, that number had shot up to 36%. Okay, so that's an enormous increase. Now, sure, you might say that that's an elevated level. The UK was in lockdown. 100% agree with you. I think the point is that even in a post-COVID world, while we believe this will sort of normalize and reduce down, it'll still likely be at a higher level than it was prior to the pandemic. And if you think of it, a lot of people, over the course of the pandemic have been forced into online shopping. It was the only way they could get certain goods and that. And they've overcome those initial hurdles and are now quite comfortable with shopping online, and therefore likely to continue shopping online in a post-COVID world. So again, this was a structural change that was happening prior to COVID. We believe COVID went and accelerated it. Again, what does it mean for real estate? Bad for the owners of shopping malls and shopping centers. The other side of the coin, though, is actually really good for the owners of good quality, well-located industrial and logistics space. When we look at e-commerce and we look at the amount of logistics space that's required to facilitate a sale in an online channel versus a store channel, it's actually a very different situation. For example, this shirt that I'm wearing today, if I bought this shirt in a store, when the shirt was stored in the warehouse, it would have been in a pallet with 1,000 other similar shirts, before it got taken to the store. However, if I buy this shirt through an online channel, this shirt needs to be packaged and wrapped and stored in a warehouse so that somebody can come and individually pick it so that it can be delivered to my front door. So you actually require 4 times the amount of warehousing space to store this shirt if it's going to be sold through, through e-commerce versus if it gets sold through a physical storefront. Okay, so just by this transition happening of retail sales moving from physical bricks and mortar into online channels, there's almost an exponential increase in the demand for industrial warehousing and logistics space. Okay, so that's hugely positive for the owners of good quality logistics space. Added to that, if you look at the end-to-end composition of logistics costs and you sort of break it down into its various components, you can see that transport is the single biggest component of logistics. It makes up about 50% of your total logistics cost. Rent's a very small component. It makes up about 4%. Okay, this is rental of the warehouse. So what happens here is when you have your retailers looking at their logistics supply chain and they're trying to cut costs, they say to themselves, well, if I can hire a warehouse that is closer to my end consumer, okay, and therefore I would be able to reduce my transport costs. If I could say cut my transport costs by 10%, that's 10% or 50%, that's a 5% reduction in my total cost. I'm quite happy to pay a 10% increase in rent. That only increases my total cost by 0.4%. So you can see the incredibly strong pricing power that the owners of this, well-located, high-quality logistics real estate actually have. And that, again, is leading to sort of a very strong tailwind behind the industrial and logistics sector. Those are just a few examples. Like I said, I'm not going to go into all the sectors, but I just wanted to give you guys sort of a feel and a flavor for some of the fundamentals that are driving these sectors, which we are excited about. Maybe just to sort of close the loop, just looking on valuation, because you might say, well, these are great stories, but obviously everything comes at a price. Well, how's valuation for the sector looking? At the moment, we touched on it earlier, we build up a required rate of return for every stock in our investment universe. At the moment, we demand 6.5% from the sector. When we look at the sector as a whole, we see there's about 6.8%, and that's sort of our total return expectations per annum over the next 5 years. obviously not necessarily in a straight line, but sort of on average over the next 5 years. And that's what we expect the sector to deliver as a whole. Okay. Obviously, we are going to construct our own portfolio, and through our portfolio construction and all of that, we believe that we can generate alpha, over and above the 6.8% that we expect from the market. And our target is to do, to deliver sort of 2 to 3% alpha per annum over and above that. So that's kind of roughly where we are, where we see the sector currently priced. And because we look at real estate and only listed real estate, our sort of highest conviction view on valuation is going to be, our bottom-up fundamental valuation. What do we demand for the sector versus what do we see it delivering? Maybe just one other slide, which is interesting. If you take a step back and look at real estate versus other asset classes, I mean, you guys will probably have your view on how does real estate screen versus general equities or whatever. But we thought this slide was quite interesting. This shows REITs versus BAA bonds. The chart on the right-hand side shows our unlevered return expectations on listed real estate, okay, minus the yields that you get on these investment-grade bonds, okay, and that's a green line over there. Now you can see, go all the way back to the 80s. On average, the spread, this differential has been about 198 basis points, so just under 2%. Okay, that's the long-term average. Every couple of years, the spread opens up, okay, and you can see there have been sort of 6 instances previously since the 80s where the spread has actually opened up above 300 basis points, and they're marked by A, B, C, D, E, and F, okay. Earlier this year, we were actually at one of those instances where the spread had opened up above 300 basis points, okay. It's subsequently pulled back slightly, but the point we were trying to make here at the time was that, there are a few instances where the spread really opens up, and on the face of it, that would imply that real estate is very cheap relative to BAA bonds, okay. So what we did on the chart on the left-hand side, we said, okay, for all of those instances, what did real estate do in the subsequent 12 months? What return did you get from real estate versus what return did you get from BAA bonds in the subsequent 12 months? And you can see for each of those instances where the spread had really opened up, real estate outperformed BAA bonds, over the coming 12 months. Now, again, that's just, purely illustrative and indicative of, what happened in the past. It's not to say it's going to repeat again, but I think it is just worth pointing out that, at the moment, real estate is screening cheap relative to BAA bonds. I think 2 months ago, it was easy to say it was very cheap. We've reached 300 pip mark. That has pulled in slightly, but it's still above its long-term average. To play devil's advocate, you might say, well, perhaps bonds are just overvalued, and we take that point. I think it was just interesting for us to compare our asset class to another alternative asset class. And I think I'm going to land it there. We said we'd leave time for some Q&A at the end. I hope I haven't gone on too long and bored everyone to tears. Maria, I don't know if you want to open up to some Q&A, perhaps.
Yes, thank you, Ryan, for this presentation. I really enjoyed it personally, especially about your investment process and the characteristic that makes you guys unique. Before we start the Q&A, I will allow you to all the attendees to speak should there are any questions. I have some questions for you. Maybe I can start with the first one. And if you guys have any question, please raise your hand on the bottom of your screen and I will allow you to talk. So on the slide, I think 13, when you guys show the fund sector allocations, I just wanted to have your views on the real estate in Africa. If you can speak to us a little bit more about that.
So Amra, I mean, this fund that we currently manage, it is a developed market real estate fund. So our mandate only allows us to invest into developed markets. So it's basically nothing in Africa. You know, the US, as you saw, is the biggest, you know, component of that. Obviously, it's the biggest market, it's the biggest size, so you'd expect it to be the biggest weighting. and then we sort of have, UK, developed Europe, and then developed Asia. So Japan, Hong Kong, Singapore, as well as Australia are sort of in the investment universe in the benchmark. Emerging Asia, like China, for example, is excluded. So that's not in our investment universe. So this is purely developed markets, real estate fund.
Okay, great. Thank you for that. So what are your views with the post-COVID and like we've seen a lot of people working from home now, and how do you see that going forward? Do you see a lot more people working from home, and what will the impact be on the office market that we see currently?
Well, that's a great question. It's something that we spend a lot of time on. I think what this pandemic showed us in the last year is we were all forced to work from home, and many of us actually managed to do so quite easily. So we believe that even in a post-COVID world, when we go back to normal one day, we believe there's going to be a hybrid model. Some companies are going to require their staff to come into the office every day. Other companies will say, we're going to shut down offices and not have offices at all. Those are the two extremes. But we believe the majority of companies will have sort of some form of hybrid model, a few days in office and a few days from home. Now, what that means for the demand for office space, it's very bad for the demand for office space. Because if you just think about it logically, if you say, assume everybody works from home 1 day a week, 1 out of 5, that's 20% less time spent in the office. Now, it doesn't necessarily mean 20% less office space, because there are going to be days maybe where everyone's in the office. But the bottom line is the direction of travel of demand for office space is definitely down. The big question is, to what extent? And most of the work we've done and reading other people, other research providers, brokers, real estate agencies, etc., it seems like the view at the moment is, long term is probably 15% reduction in demand for office space, which is quite significant. You lose 15% of demand, and that's going to be very tough for the owners of office real estate. And that's one of the things that's actually making us quite negative on the sector. We were actually negative prior to COVID for a few reasons, but this has sort of almost accelerated that view.
Well, yeah, thanks. I agree with you on that point. And then moving from there, what do you think the single biggest takeaway on the impact of COVID-19 had on your fund?
The biggest takeaway for us is quite interesting, is we actually saw COVID went and accelerated some structural changes that were already happening even prior to the pandemic. It just accelerated that. We touched on earlier on e-commerce. That was a change that was happening already. COVID went and accelerated it. You think of data centers as well. There was strong tailwind for online data usage. It accelerated that. So take a step back and big picture takeaway across most sectors. COVID really accelerated things that were already happening before the pandemic.
Great, thanks. And then perhaps we have time for one more question. What would be your views on the post-COVID world with regards to the hospitality industry worldwide?
So that's actually very interesting. The hospitality sector has obviously taken a lot of pain over the last year. Most hotels were completely closed. Hotel businesses are really tough businesses. You have very low margins, and when you have to close your hotel, some of the costs will remain at head office. So what we saw last year, some of the hotels actually had like negative operating earnings, which seems crazy, but it actually happened. The big question for us has been, as economies open and we get back to normal, what does the long-term prospect look like for hotels? Now, again, you kind of need to take a step back and say, what was the environment prior to COVID? So prior to COVID, if you look at the hotel industry, and I'm talking particularly in the US because it's sort of the biggest representation, you had an oversupply of space, Okay, and the REITs would admit that to you. They would always say it doesn't relate to their portfolio, but I mean, a place like New York, it was sort of consensus view, even amongst the hotel owners, that there was about 10% excess hotel space in New York City. So you had an oversupply of space, okay? You then had the phenomenon of Airbnb, which is almost like providing a shadow supply pipeline. You know, people are now considering, well, I can either go to a hotel or I can use Airbnb. So that was almost exacerbating the supply side of the equation. Now, something that we spent a lot of time thinking about, you know, the long-term impacts of COVID is, what does virtual meetings and Zoom meetings and team meetings like we're having today, what does that mean for business travel long-term? Because when you look at particularly at the listed hotel owners, the majority of their portfolios cater to business travel, about 2/3 cater to business travel. Now, our view is that, you know, over time, I mean, I think when things open up and that, we've all got this sort of pent up, you know, travel, and we all want to get on the road and go and see our clients and all of that. But sort of once that normalizes, we believe that there will also be a structural reduction in the amount of business travel that took place prior to COVID. Yeah, so for example, if you saw your clients 4 times a year in person, maybe you're going to see them twice a year in person. The other 2 times you're going to, you know, do via Zoom or Teams or Skype meetings. So we believe there's been a structural reduction in long-term demand for business travel, much like it's been with office space, for example. And we actually think that, you know, at the moment, the market's almost underappreciating that. You know, if you look since the 4th quarter, if you recall that slide that I showed at the beginning of the presentations where hotels surged after the vaccine news happened, I mean, that run sort of continued into the current year, to the point now where hotels, you know, depending which stock you look at, are not too far off their pricing levels prior to COVID. Okay, so we're basically back to where we were, but with arguably a much worse outlook for your long-term demand. You know, again, looking at various surveys and people's point of views, you know, some surveys are coming in saying that, yes, C-suite, you know, company management, their plans are for up to a 40% reduction in travel spend. Okay, now that's going to be enormously impactful for these hotels. So we think that there's some longer term consequences. Obviously, when things open up, there's going to be a bit of pent up demand for travel. You know, people want to go on holiday. People, you know, business people want to see their clients. But we think long term, much like with offices, there has been some structural impact to long term demand.
Well, thank you for that, Ryan. And I think we'll end here. Well, if you guys have more questions, please email me. And if I can't answer them, I will make sure that I get the right person to answer this question for you. Well, first of all, I thank you again for your time this morning, Ryan. We really appreciate it. And to all of you, I hope that you found the presentation insightful and that it will help your client interaction going forward. Just as a little reminder, we have our 4th webinar tomorrow morning at 9 o'clock Central Africa time on the Denker Global Financial Fund. And we hope to see you there. And but for now, thank you again, Ryan, and we'll definitely have you guys again soon with us.
Thanks, Amar, and thanks to all the participants for attending. Appreciate the time. Thank you, everyone.